nowhere in the books, nowhere in the universities, I could find. Only Mr. Chitranjan Dhar reminded us of that. Although we used to hear a lot of quotations from Mr. Chok, Mr. Kapoor, Mr. R.P. Agrawal, whom we all have taken forward and taken over from them, and then ITC Bhadrachalam Paper Board, PSPT is what it is today. Remembering all of them, and today we start this session. Although traditionally it is called as finance for non-finance managers, today I'm able to give just, I said 60-minute roundup, but Surya is unable to give 60 minutes because of the system limitations. Probably I would end up in 40 minutes. In 40 minutes, which is otherwise a semester course or a 2-day workshop, but then I would be able to just introduce certain definitions and concepts, so that the purpose of recapitulating finance and accounts after we work long in the industries and academies helps us to refresh our memory. That's only limited purpose, but otherwise I don't think it's possible to deal any deeper concepts in this limited time. Now, looking at finance, financial management, the definition says that it is the process of planning, execution, resourcing, controlling, and reviewing of financial investments. Now, along with this, the accounts will also go, and I would give the definition of accounting as well. Accounting is the process of collecting business information, analyzing, and presenting it to the management. Financial management is responsible for the profitability, the financial planning, the shareholders of the company, all the stakeholders of the company, whereas the accounting is responsible for preparation of the books of accounts and presenting to the management as to what is the state of the business. Are we making profit? Are we making loss? Should we close this business? Should we expand the business? All these decisions can be taken based on the accounting information provided by an accountant. Further, the financial manager will resource the money from various sources like banks and capital markets or institutional investors or whatever. And now that's how it goes. Now, having said the basic definitions of finance and account, and these are the definitions as we hear from various institutions, but then it could, the English could differ from company to company, place to place, and so on. But then the funda is that the planning of the whole thing is by finance, and writing of the books is by accounts. Now, the finance and accounts people, they dwell upon 4 important jargons or definitions in their day-to-day working: assets, liabilities, debits, credits. An asset is something which gives recurring benefits to the business. An asset is something which gives recurring benefits to the business. A liability is inverse of that. For want of time, I would not repeat. Debit is something which is unfavorable to business. Credit is something which is favorable to business. It is not so simple. There are rules of accounting and all that. And with these 4 entities, accountants prepare the statements of account. Using that, a finance manager will do the financial planning and profitability planning, capital budgeting, investments, dividends, internal stakeholders, external stakeholders, giving their due to what it is. Now, the basic fundamental on which a company's accounts is maintained by keeping the equilibrium of the business at any given point of time. By equilibrium, what I mean is the business should not lose. Okay, when it is losing, we must tell it is this position. Now, to keep that equilibrium, accountants will follow one formula called basic accounting equation. It reads assets is equal to liabilities plus owner's equity. Now, assets we know, all the physical and non-physical assets which give recurring benefits to the business. Liabilities which are unfavorable to the business. Owner's equity is the money invested by the owners, the promoters and shareholders. That is owner's equity. And business, it is kept in the liability side because as per the basic accounting rules, generally accepted accounting norms, business owes that money back to the owners. So therefore, the owner's equity is always kept on the liability side, and it is a liability. Of course, we don't pay it back to the owners. It's always in the business, but conceptually, it's treated as payable to the owners. Therefore, it is in the liability side. So that's how they maintain the business equilibrium. Now, for this, what an accountant does is he prepares several statements. The first book of account maintained by an accountant is the cash book. Now, for example, if you go to a bank, at the counter, the person there in the counter is receiving and paying, receipts and payments. So all these receipts and payments are continuously written because there's no time. What they will do is, okay, received from Rama and Company, paid to XYZ, again received, paid. It is on a day, there can be n number of receipts and payments which are written in a continuous running mode. So that is a cash book of a bank.
Surya, you are not muted, everybody. Yeah? I can hear some kitchen utensils of the background. Surya.
So we were discussing the cash book. Yeah. Cash book is a statement where continuously the quick payments and quick receipts are maintained. And the next book maintained by the evening, what an accountant does is he will prepare what is called journal. It continuously happens. Now it is all computerized accounting. It continuously happens. These activities which are written in the cash book are classified into debits and credits. All debits in the first column, all credits in the second column are separately shown, and this particular statement is called journal. 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 Journal is a book of accounts in which transactions of parties are entered, classified as debits and credits. This is the definition of the journal. The third book which they maintain is ledger. Now suppose this journal which I mentioned contains n number of parties, customers, suppliers, all other stakeholders in a mixed condition. We don't know who comes when and on which date he comes when. It's a running account. And in the second book, he has written as debits and credits. We defined what is debit and what is credit. In the third book, he will pick up all transactions of a party and write on a separate page. Suppose Rama and Company, all transactions, payments and receipts, supplies and acceptances, all that is done by Rama and Company are written in a separate page. That is called ledger of Rama and Company. So on the heading, you have Rama and Company, and in that only the transactions done by Rama and Company date-wise are recorded as debits in one column, credits in one column. Now, this will not balance because any point of time, either we owe to Rama and Company or Rama and Company owes to us. So difference between the first column and the second column is written as debit, DR, capital D, small r, debit record. That's why we call it as DR, credit record, CR. So either net debit or net credit is written at the bottom. I'm talking of the manualized accounts. The computer does it on own, but then basically we have learned through manual accounting. So my lingo would be akin to manual accounting. So forgive me for that. So net DR or net CR is written in the ledger page of Rama and Company. Furniture account, Bhadrachalam paperboard account, Surya Narayana account, Barla's account. So there are a number of pages in which individualized exclusive transactions of each party are written, and a book which contains all these pages is the ledger book. Now, suppose I pick up only the end figure of each page and write on a separate page, all net debits and net credits are written in a separate page. That separate page is called trial balance. At this stage, all debits must be equal to all credits. Sum total of debits must be equal to sum total of credits. If they are equal, then your business is in a state of equilibrium. If they are not equal, there is a goof up somewhere. What the accountant does is, he will do what is called reconciliation of accounts. He goes to bank, tallies whether all the checks are accounted for. If any check is lying in the drawers of the accountant, or any checks are lost, or instead of 4 zeros, somebody would have 5 zeros or 3 zeros. All these errors will be identified, rectification of errors it is called, and bank reconciliation statement is made, BRS statement is made, after which the trial balance is nothing but the net credits and net debits of all the ledger pages written in a separate page. That separate page is called trial balance, which has to balance. If it is not balancing, there is a goof up, and such balancing is achieved by rectification of errors, and that's how it is balanced. So these are the 4 statements: the cash book, journal, ledger, and trial balance. Simply, I can't make it more simpler than this because there's no time. Next, what the accountant prepares is what is called trading account. Now, the trading account, all the revenues are taken, and the cost of goods manufactured, okay, CGS, cost of goods manufactured, is subtracted from the revenues, and gross profit is arrived at. Now, the factory expenses, all others are not yet all others are not yet taken, but revenues and cost of goods sold are subtracted, and gross profit is reported, because the purpose of telling a gross profit is whether the expenditure that I've incurred from my pocket at least is meeting or not. By selling these goods, I am able to meet the money which I am putting for acquisition of raw materials and other things, just that much if I'm making, I will go to the factory again and try to recover other things later on. So trading account is meant for telling the business owner that, sir, your business is doing well. Your business is not doing well. Then he will take corrective action. A quick report of whether the business is able to meet the bare minimum expenditure, which is cost of goods sold or not, is trading account. Thereafter, he or she would prepare the profit and loss account. The difference between profit and loss account and trading account, both are for the entire year from 1st April to 31st March. All transactions are taken into account. And now in the case of profit and loss account, or it is also called income statement or statement of account. In this statement, all revenues, all expenditures, including the cost of goods sold, depreciation, factory expenses, interest, income tax, everything is calculated and net profit is shown. So the purpose of profit and loss account, which is a statement of revenues and expenditures for the year. That is the definition of profit and loss account. To arrive at the net profit, and the net profit, out of the net profit, we declare a percentage of it as dividends. Board of directors will say, okay, give 30% dividend. So 30% of this is marked as dividend and distributed to the shareholders, who are eligible. After distributing the dividend, there is what is called the remaining amount. The remaining amount, which will be added back to the owner's equity, because that final profit belongs to the owners. So that is how the profit and loss account is prepared. I would not be able to go into much more details. Now, the next statement which the accounts and finance makes.
Excuse me, Barla sir. Excuse me.
Sheet.
Barla sir.
Yeah. Yeah, sorry.
We are in which page now? You have to tell me to go forward. Where we need to this? We are sharing the screen. Barla sir.
Otherwise you remove the screen sharing. Yeah, bring it back only when he needs it.
Okay, that's what I am saying. Oh, shall I remove the screen share, Barla sir? I think he got disconnected, sir.
Oh.
No, I am okay. I am okay.
Okay. Shall I remove the share screen? Because
yeah, remove.
Okay.
Am I okay? Am I audible?
Yeah.
Very good.
Yeah. So therefore, what happens is the accountant prepares the profit and loss account, and finally tells the business so much is remaining after the dividends are given. That final account is added back to the owner's equity, and that's how the business continues.
Technically called reserves, Barla.
Yeah.
Is that right? Right.
Reserves and surpluses.
Right.
Okay, all this going account is called reserves and surpluses. Now after this, what the accountant does is he will prepare a balance sheet. Now, balance sheet is defined as a statement of net assets and net liabilities arranged in decreasing order of liquidity as at last day of the accounting year. Now, it is not for the year. Balance sheet is valid as on 31st March 5 p.m. It is not 1 minute before, 1 minute after. It is valid on the last day, last working hour of the company accounting year, that is 31st March, let us say. It shows the net assets and net liabilities. The word net means after doing the adjustments. There are loans on which the interest is adjusted. There are debentures. There are fixed assets. Depreciation is adjusted and the depreciation is added back to the depreciation account, sinking fund account, and so on. After doing all these adjustments, they will show the net position of assets and liabilities. And assets and liabilities must be equal at the bottom, sum totals. And this is called the balance sheet. What is the purpose of balance sheet? The purpose of balance sheet is to know the net worth of the company. How much I owe to somebody, how much somebody else owes to me, what are my debtors, what are my creditors, what are my assets, what are my liabilities at the end of the year, I would know. So that I can determine that my business is good. I have so much reserves, so much surpluses, it is available, therefore I can plan my next year. So these two powerful statements like P&L account and the balance sheet are the two instruments based on the primary statements like cash book onwards, which I mentioned. That's how the accountants will prepare. They also have the responsibility to make what is called a cash flow statement and funds flow statement. By cash, what we mean is an entity which has got 100% liquidity, cash or near cash. Checks and quickly realizable assets are called near cash or cash equivalents. And cash is pure cash. Bank balance, checks in reserve, instruments which are payable within a short period. These are all cash equivalents. So cash and cash equivalents are termed as cash. And from where the cash is coming, where the cash is spent, is known by the cash flow statement. Now, why cash flow statement has to be prepared? Because if the business is investing a lot of its money in the day-to-day activities itself, it means that it is not invested in the long-term assets which are useful for making production. So it has compromised its production assets, ability to produce more by not investing in long-term assets. It has kept unnecessary, unwanted money in the business. Thereby, you are seeing the cash and cash equivalents as much more than required. So for this purpose, they prepare what is called cash flow statement. Similarly, a little more if you go, funds flow statement. Fund is defined as the difference between current assets and current liabilities. Current means within 1 year. Normally, in the normal parlance, the current is within 1 year. Anything beyond is long-term assets or permanent assets. Now, the difference between the sum total of current assets and current liabilities is called fund or working capital. Now, working capital is required for payment of salaries, payment of utilities, current bill, water bill, and so on, advances and so on. So therefore, they would prepare what is called cash flow statement and funds flow statement after they make the balance sheet and prior to the income statement based on the primary accounting books. Subsequently, ratio analysis, certain ratios, the accountant has to keep them ready, because although you have given the income statement and financial assets position by balance sheet, I still would like to understand more deeply. Give me certain ratios. Current ratio, which is current assets divided by current liabilities. If it is 1, current assets are equal to current liabilities. The business is just able to meet its assets and current liabilities. Now, if the ratio is more. That means liabilities are less, assets are more, good enough. If the ratio is less than 1, liabilities are more, which is the denominator. So therefore, you need to do something about it. So to know these kind of implications, we would ask for what is called current ratio, which is defined as current assets divided by current liabilities. Now examples of current assets: bank balance, checks in reserve, accounts payable, tour bills which are pending, which are all within 1 year. And similarly, current liabilities, debtors which are receivable, creditors which are payable, so all these things. Now they also may calculate the price earning.
Barla, receivable is an asset, not a liability.
Yeah, debtors is receivables, which is an asset.
Yeah.
Creditors is payables, which is a liability.
Correct.
So therefore, then we also prepare a ratio called PE ratio, price earning ratio. Now your company share, you would like to monitor how your share is performing well, because that is the market value you have. So therefore, you would like to, at what price your share is selling, and what is the net profitability of the company. With that ratio, we will like to know the share is highly linked to the profitability of the company. There are some companies, irrespective of profitability, the share zooms on brand value or anything else. So therefore, it all depends. Now, why there's a very important case study on why this particular price earnings ratio is maintained. I go back to long years back when Infosys subdivided it's divided its share, which was a 100 rupee share, quoting it something like 3,500 rupees per share in the market. 100 rupees invested would fetch you 3,500 rupees. Now it was decided to split it into 10 shares. So what happens is, a person who's having one share, quoting it to 3,500 rupees, his earning is, if he sells that one share, he would get 3,500 rupees. Now, because the share split, which ITC has also done, because the share split, he's got 10 shares. And fortunately for him, the share is still quoting at 3,500 or 3,000 rupees, because the brand value and the way company was doing so well, people are still buying at 3,500 rupees. So he got 35,000 rupees, 3,500 into 10, he got 35,000 rupees overnight. So you people have purchased lakhs of shares, and therefore people have become overnight millionaires. So therefore, that is, even Narayana Murthy's driver, whose name is also Murthy, became a millionaire because Narayana Murthy gave him in charity some shares, which after the share split, Murthy's driver could sell and make hell of a money. Now, financial management is important for these implications. How the wealth is created, ultimately. Wealth creation is the major goal of financial management. It is not simply producing and selling. There is a third thing by where you will maximize the wealth of a company, like by acquiring funds at low cost. For example, if you get 1,000 crores in India, they will charge you, let us say, 10%. But if you acquire the same funds from international markets, they will charge you 2% or 2.5%, because in the international markets, as I mentioned earlier also, the interest rates are very low. In the developing countries, interest rates are very less because they are in the beginning of the cycle. So the finance head, the finance manager, would do all such decisions so that cheaper funds are substituted for expensive, costlier funds. That is another important thing which they do besides share splitting and things like that. And ultimately, suppose a debt equity ratio. we have what is called debt, what is called equity. Debt is what we borrow from banks and other lenders. It's called debt, D-E-B-T, debt. Equity is what owners have invested, what shareholders have invested. So debt upon equity will tell you how this ratio will be. The ratio will be 2 or 2.5 or 3 or whatever it is. If you acquire funds from banks and financial institutions, you have to pay interest. Therefore, there is a cost. Am I earning that much or not? If your company is earning an ROI, returns on investment of 10%, and if you acquire funds from institutional lenders at 12%, you have decided to make loss. You would make some decisions such as, my cost of funds is this, my company profitability is this, my cost of funds should always be less. In sum total, my cost of funds should always be less so that my company makes profit. That's how he does the profit planning. Apart from that, if the company's image, company's puckered, we call it in the market, is so good, he can go for the IPO. He can go for a share announcement. So what he does is, when he gets share, he doesn't have to pay any interest. At the end of the year, he may pay dividend. After all, dividend is paid out of net profit. It is up to you to declare how much you want to pay. If you got 100 rupees, you pay 30 rupees. You still have 70 rupees. So that way, the equity mode of investing would also be decided by the financial manager. That's why the financial guys like Mr. Khandelwal, Mr. Unni, Mr. Vasudeva Rao, Desai, Varadarajan, our colleagues whom we worked with in ITC Bhadrachalam paper boards, they were all doing this: receivables, debtors, creditors, investments, banks. Their world is all this, and then they've all done fantastic job. Therefore, the company had come up so well. In the recently written book, I have shown how the company's funds were acquired and invested in the last section. It is a fantastic story. It's a story of a moral story for anybody, any time in future also. That's how the investments were made in ITC Bhadrachalam paper boards. So therefore, the ratio analysis, price earning ratio, debt equity ratio are given at the end of the balance sheet, after making the balance sheet, so that the decisions for further planning are made. Now, if I have 2 minutes, Surya, I would also go into little more.
Sir, we have now 1 minute more. We have to, it will get disconnected after 1 minute.
Yeah. So they will also do what is called capital budgeting. Now, capital budgeting is a project exercise where they calculate the investments and returns, reduce them to the present value by a ratio called IRR, internal rate of return, where the future incomes and the future returns are equal to the present investment. That rate of return is called IRR. And there are several payback methods. There are several methods. And the purpose of all this is to see that in how many years my investment will come back to me and leaves me a surplus. That's called capital budgeting or finding a payback method. There are several complicated methods.
I request all participants to join back when it gets disconnected, or in 1 minute it gets disconnected. Please join back. Now I am ending the meeting. Barla sir, please join back.
It may come back. It may continue also suddenly.
Yeah.
Sometimes Zoom is giving
Zoom
that
allows,
support.
yeah,
But
allows it.
it sent me